The U.S. stock market is currently closed. As of the closing bell on Thursday, October 9, 2025, shares of SoundHound AI, trading under the ticker symbol SOUND, ended the session at a price of $18.58 per share. This represented a downward move for the day, with the stock shedding 30 cents, a decline of 1.59%. Now, that closing price might seem like just another data point in a volatile week for tech stocks, but what it masks is a fundamental misunderstanding of what is actually driving this company's value. The widespread expectation is that SoundHound's fate is tethered to major announcements: a new car manufacturer signing on, a massive restaurant chain adopting their technology. The reality, however, is that the most critical developments are happening behind the scenes, in the silent accumulation and processing of query data, which is building a competitive barrier that few seem to appreciate. The daily price fluctuations are noise. The real signal is in the increasing complexity of the conversations their AI is handling, a metric that doesn't make headlines but points directly to future profitability. Most investors, particularly those active on platforms like Robinhood or SoFi Invest, view SoundHound AI as a direct challenger to the giants of Amazon's Alexa and Google's Assistant. This narrative frames the company as a high-stakes bet on displacing big tech in the voice AI space. The stock's performance is often seen through this lens, surging on partnership news and dropping on fears of competition. But this expectation is flawed. The reality is that SoundHound isn't trying to win the consumer smart speaker war. Its strategy is far more intricate, focusing on becoming the essential, independent platform for businesses that cannot or will not hand over their customer data and user experience to a direct competitor like Amazon or Google. The real battle isn't for the living room. It's for the car, the drive-thru, the call center, and the countless other commercial applications where a neutral, customizable voice platform is not just preferred, but necessary. The recent pullback to below the $19 mark isn't simply a reaction to broad market weakness. It reflects a deeper institutional recalibration, weighing the immense potential of this B2B-focused model against the significant operational costs and the long road to consistent positive cash flow. While many retail investors using the Robinhood app are trading the name, institutional clients at firms offering Fidelity wealth management or using interactive brokers are analyzing the company's gross margins and customer acquisition costs with a fine-tooth comb. Let's dissect the recent trading activity more closely. The 1.59% drop to $18.58 occurred on moderate trading volume, suggesting it wasn't a panic-driven sell-off, but rather a measured continuation of a consolidation phase. For weeks, the stock has been trading in a range, influenced heavily by the sentiment surrounding other AI leaders like NVIDIA stock. When NVIDIA shows strength, a tide of optimism lifts speculative AI plays like SoundHound. Conversely, any perceived weakness in the AI hardware giant sends ripples of concern through the software sector. This codependence is a significant short-term factor. Many traders who manage their individual brokerage accounts are essentially using NVIDIA stock as a proxy for the entire AI market's health. However, the recent institutional filings paint a more complex picture. While some momentum funds have been trimming their positions to lock in profits from earlier this year, there's evidence of quiet accumulation by long-term growth funds. These are the investors who are not trading the daily news, but are building a position based on a multi-year thesis. They understand that the company's value is not in its current earnings per share, which remains negative, but in the strategic partnerships it is locking down, especially within the automotive industry. The deals with giants like Stellantis and Hyundai are not just revenue sources, they are massive data acquisition engines, feeding the AI models with millions of real-world interactions daily. This data is the true asset. Investors looking for investment help or considering a self-investing strategy through platforms like Schwab Intelligent Portfolios need to understand this distinction. The stock's price is a sentiment gauge. The company's underlying value is a data story. So what does SoundHound AI actually do? At its core, the company provides an independent voice artificial intelligence platform called Houndify. This platform allows businesses to integrate custom-branded advanced conversational interfaces into their products. Unlike closed systems like Alexa, Hyundai offers businesses control over their branding, user data, and customer relationships. Their business model is multifaceted, generating revenue through royalties based on the number of units shipped with their technology, like cars, subscription fees for ongoing access to the platform, and professional services for custom implementations. Past performance has been a textbook case of a high-growth tech company, rapidly expanding revenues coupled with significant operating losses. The last earnings report was a prime example of the expectation versus reality dynamic. The headline revenue figure beat analyst expectations, triggering an initial pop in the stock price during after-hours trading. However, the reality set in when investors and analysts on the conference call scrutinized the numbers. Gross margins had slightly compressed due to the costs of servicing new large-scale clients, and operating expenses had increased as the company invested heavily in research and development. This is the classic growth stage dilemma. You have to spend aggressively to capture market share, but it pushes profitability further into the future. This is a level of analysis that often separates a casual trader on a simple SoFi trading platform from a professional using the advanced tools available at interactive brokers. The latter is modeling cash burn rates and trying to pinpoint the exact quarter when the company will become self-sustaining. Looking toward the future, the outlook for SoundHound AI is a fascinating balance of immense opportunity and significant risk. The primary catalyst for the stock would be the announcement of another major automotive or IoT client, which would validate their technological lead and expand their data moat. Another powerful driver would be a clear demonstration of improved monetization. If the company can show rising average revenue per user or per device, it would signal that its model is not only scalable, but also increasingly profitable. The performance of the broader market, and particularly bellwethers like Apple stock and Tesla stock, will also play a role, as a strong market provides a better environment for growth-oriented stocks to thrive. Many Fidelity ETFs and Fidelity mutual funds that focus on disruptive technology hold shares of SoundHound, and their continued support is crucial. However, the risks are as substantial. The most obvious threat is competition. While SoundHound has a technological edge in its specific domain, it is operating in a field with some of the most well-capitalized companies in the world. A renewed push by Google or Amazon into the automotive B2B space could apply significant pressure. Another major risk is execution. Scaling operations to meet the demands of global partners like car manufacturers is a monumental task fraught with potential delays and cost overruns. Finally, there's the macroeconomic environment. If interest rates remain elevated, the cost of capital for a company that is not yet profitable becomes a major headwind. Investors become less patient and are more likely to rotate out of speculative names and into safer, cash flow positive businesses. Comment below with your thoughts. Do you believe SoundHound's specialized technology is a strong enough defense against the sheer scale of its big tech competitors? In conclusion, the narrative surrounding SoundHound AI is often oversimplified. The market's expectation is for a straightforward story of competitive wins and losses against household names. The reality is a far more complex equation involving data acquisition, margin profiles, and the strategic value of being an independent platform in a world increasingly wary of walled gardens. The recent dip to $18.58 is not a sign of failure, but a reflection of the market's struggle to price a company whose true value lies in a future that is still being built. The disconnect is not in the company's vision, but in the market's patience. Understanding this distinction is key. The real measure of SoundHound's success won't be found in the daily stock chart you see on SoFi stocks or the Fidelity mobile app, but in its ability to turn its growing ocean of conversational data into a durable, profitable, and indispensable piece of the modern technological infrastructure. This is for education and entertainment only. Invest at your own risk.